Hi, welcome to our second podcast with Home Estate Agents. Today we are focusing all on first-time buyers. So without further delay, I'd like to introduce you to Katie Pring, one of my lovely mortgage consultants who's worked with us for quite a few years. Katie, hello.
Hello.
Thank you for joining me, Katie. I know that this might not be within strictly your comfort zone, so I really appreciate your time today, and I'm hoping we can really get some good information over to our first-time buyers today. Talk me through, how long have you been in the industry, or tell our viewers, how long have you been in the industry? Where have you come from?
So I've been in the industry on and off for about 25 years. Started out kind of pre-children in the industry. Mum of two boys, kind of left the industry for several years due to having small children. And then once they started at school, kind of dipped my toe back into it, and then came over to home probably about 8 years ago now. And just works really well for me because of having kids and kind of working around the family. So, yeah, I've been doing mortgages on and off for 25 years.
Okay. Obviously, you don't look old enough. So I'll tell you a little bit about me, if that's all right. I have been in the property industry for 30 years, as you know, and I've been in the mortgage and finance industry for 25 years. And Katie's one of 6 of us that give mortgage advice at home. Okay, so on to our subject today, which is how to get the keys to your first home, the $1 million question, yeah? We're looking to help all of you first-time buyers out there that are looking to get on the property ladder, the do's and the don'ts, and some advice. We are going to be talking about deposit tips. We're going to be talking about credit scores and reports, special schemes that lenders are offering specifically for first-time buyers, what's myth and what's truth, and a few jargon busters. So I have a few facts. You know some of these as well, Katie. I'll need your input on this. According to recent research, 4.9 million adults still live with their parents in the UK, which is a large number. And I think it's getting bigger and bigger each year due to the economy, etc. Do you know what the average age for a first-time buyer is currently?
The average age at the moment is 33 years old for a first-time buyer.
So many years ago, that was a lot lower, but due to the cost of properties, especially in the southeast, obviously, and bordering London, it's getting higher and higher, isn't it?
And the other thing we've heard is a lot about the boomerang generation. So those that have kind of left home for university, maybe done a few years renting, and then they've come back to mum and dad to be able to save for their deposit, basically, which is what is also pushing that average age.
We see a lot of clients that are taking that strategy. The average property price for a first-time buyer, now this is an average across the nation, that does include London, apparently is $311,000. Again, many years ago, that was, only something to dream of as a first-time buyer. Now that's reality. Do you know what the average term is that people are taking out on a mortgage for first-time buyers at the moment? Again, used to be 25 years. What is that now? Do you know?
That's pushed up to 29. And that, again, is because we're seeing the average age of the buyer has gone up. So, some of my younger buyers are even going for 40-year terms.
Wow.
So we have seen those mortgage terms just extending and stretching out a bit.
Okay. It's not all bad news, though, is it, Katie? Talk to me about interest rates.
So anyone that's bought a house in the last few years will be aware of what's happened with interest rates, and obviously kind of post Liz Truss and that kind of time, there was a huge spike in interest rates very, very quickly, which hit the news. People have been aware of, interest rates are high. What we've actually seen in the last couple of years is that those interest rates have started to come back down to what we would call normal. Now, for anyone that's owned a property for over 10 years, you will have known rates of around 1% and 2%. That's not normal. When you're looking over a kind of 50-year average, that isn't your normal interest rate. Where we are now, around about 4%, is where the sort of economic normal is over that long-term period.
Yeah, I would agree. I always talk about the 1% and 2% rates as fairy tale rates to clients. I say, that they don't exist anymore, and it's unlikely they ever will exist. It was a very particular time in the economic global community where we had these rates, and people thought they were going to stay around forever, and obviously they didn't. So part of our job as advisors is very much trying to protect our clients of any future interest rate increases, especially first-time buyers. They're not used to paying bills. that they're not overstretching and that they're well within the budget that they can afford. Okay. In relation to steps, how do we even start? People talk about credit reports and decision in principles. What are they? How do they work for a client? What should they do first as a first-time buyer?
As a first-time buyer, I think the thing I always say when a client sits in front of me is often they say to me, I'm not even thinking about buying a house yet. I don't want to buy a house for a year or 2 years. I've not got anything saved. So the first point is it's never really too early to see a mortgage advisor. Those are the perfect clients for me.
Yeah.
Because if you come in and see me 2 years before you buy a property, we know what we're working with. We can look at affordability. But most importantly, there are kind of 3 key things I think as a first-time buyer you need to be aware of. One you can do immediately, which is a credit check.
Yeah.
That's something that basically will, there's lots of free credit checks that you can do online, and it gives you an idea of what your credit score is. Now, that is something that a lender will want to know at the point that you are applying for a mortgage. Now, there are also lots of other ways in which you can potentially increase that credit score if it's not where it needs to be, which is why coming in early is a really good thing, because you may then have a year to boost that credit score, do things to help with that credit.
It's all in the planning, and we both see clients early on, as you said, maybe months or years ahead of their plans. And as you said, we may see clients with a low credit rating, and we can advise on boosting that up and improving things in readiness for their move. What sort of thing would we be looking to advise first-time buyers to change in their financial habits to make the path a bit straighter to buy?
Well, the thing that I find interesting is the number of first-time buyers that come to me and say, I haven't got any credit. And that, is, you would think that is a good thing. But actually, for first-time buyers, having some credit is really important. Now, these days, most mobile phones are on some sort of credit agreement.
Yeah.
But if you're still living with mum and dad, and some of my clients' mum and dad are still paying for their mobiles,
yes,
it's worth thinking about taking out a credit card. So that's step number 1. Now, the thing I would say about a credit card that is very, very important is that if you're spending on it, you pay it off. So maybe use it for your fuel every month and then pay it every month, because what a lender wants to see is that you can handle credit. So that's something that's pretty easy to kind of do immediately.
Showing that track record, isn't it, of reliability? Yeah. Because without any track record, you're an unknown liability.
Absolutely.
And as you said, lenders are going to be more hesitant, and building your credit profile to say, I can borrow money and I can pay it back is really important. But we must stress really strongly that it's not about getting into debt. No. It's about spending a certain amount of money and paying it back, as you said, the same month. It's a standing order that clears it every month.
Yeah, because the worst thing you can do is take out credit and then not service that debt, because then that's going to have a negative impact
Absolutely,
on your credit score. So only do this if you feel it's something that you are able to cope with, and you think, yes, I can do that every month.
And we can walk clients through that, can't we? So absolutely. We are there to literally hold hands with that process.
Yeah. And the other thing that is relatively new to the market is something called Experian Boost.
Right.
So this is something where if your credit score is not as high as you had hoped, what Experian Boost will do is it will look at all the other outgoings that are coming out of your bank account that aren't necessarily credit related, that you are paying regularly. So things like your Netflix subscription, your Spotify subscription, all of those things, if they can see on a regular basis you are paying them, then they can use that to boost your credit score. So again, if you go on to Experian, there's the option there to do something called Experian Boost. You can do that immediately, and you should see that have an immediate impact on your credit score. It doesn't have to be done in line with kind of a mortgage application. You can do that completely standalone. So that's something else.
Is that the same thing where you get notified if someone tries to access something financially of yours and you get a notification, or is that something different?
That is Experian Lock, I think, but it's still part of the same thing. Yeah. So essentially, some clients can do Experian Lock, which basically limits their spending. So that tends to be, I would say, for clients that have maybe had difficult credit histories, and they want to put a lock on their kind of credit to prevent them using it.
Okay, thanks for clearing that up. That's great. So we know we need to get our credit in order. We need to show a track record. Sometimes people talk about a DIP, a MIP, an AIP. What are they? Why are they called different things?
So essentially, they are the same thing. So a decision in principle
is a DIP.
Is a DIP. A mortgage in principle is a MIP.
Yeah.
And an agreement in principle is an AIP. And I say this to clients because it's your first house, the first time you've done this. How on earth are you going to know that those are all the same thing?
Yeah.
And different estate agents will ask for different things.
Yeah.
Someone will say, have you got a mortgage in principle? Someone else will say, have you got an agreement in principle? And you think, well, I've got a mortgage in principle, but what's a DIP?
Yeah.
They are essentially all the same. And it's a way of the lender kind of doing what is usually a soft credit search to make sure that your credit score is where it should be. And then they also look at affordability and are they willing to lend? So most estate agents will ask for it at point of offer on a property to show that you've investigated your mortgage options and you know that you can afford to buy this house, basically.
Because the reality is, if you're out viewing properties and you haven't checked out your finances to this extent, you find a property, you fall in love with it, you offer, it gets accepted, and then you hit a wall, and no one wants to do that. So by getting a credit check done via an independent broker, ideally soft search, because if you have multiple credit checks done, it can harm your credit rating, which we can talk you through all of that. We can hold your hand through the whole process. We can arrange that credit check for you to provide to an estate agent or whomever asks for it, should you find that property and not be disappointed at that time. Would you say that's
100%? And I think that ties in really well to affordability as well.
Right.
Because what I find with a lot of first-time buyers is they are pleasantly surprised by how much they can borrow.
Okay.
And a lot of them have gone online and filled out, one of the little, how much can I borrow calculators at the bottom of Rightmove, that sort of thing, and think they know what they can borrow. But obviously, each lender has a different way of assessing affordability. So it's also a really useful tool to kind of work out, well, okay, what will a lender lend to me versus what can I actually afford? So the difference there is a lender may lend you £300,000. If that's going to cost you £4,000 a month, that's out of your budget. So it's kind of finding that middle ground between what can we borrow and what can you afford monthly to pay.
And again, this brings it back to coming to a property mortgage professional, because going online, doing a quick search really isn't going to cut it, because there's multiple lenders with multiple criteria that are completely different. For example, when assessing income, Santander will deduct your pension contributions. Your Nationwide will deduct your travel to work. And so there's literally can be thousands and thousands of pounds difference, can't there, between a lender. And our job and our skill is to say, okay, well, we've got to take into account this, this and this. Therefore, we think the best fit for you is going to be this. This is why. And we're able to solve a problem, as opposed to clients just randomly going on thinking, yeah, I'm good to go, when actually they might not be.
And on that basis, there are things that we know as property professionals that even, experienced buyers wouldn't know, let alone a first-time buyer.
Yeah.
And so it's using kind of that experience to your advantage. An example of that is if you have got a loan, for example, with 6 months left to run on it, but it's £500 a month, it may actually be beneficial for you to use that money that you've saved to pay off that loan, and then you're going to be able to borrow a lot more. But that's what we can look at for you.
And the other side of that coin is we have some lenders that if you've only got 6 months left to run on a loan, they'll ignore it as a commitment. There are so many caveats to every step of the way. And as I said, that's our skill set, isn't it?
Exactly. And I mean, I had a client the other day that I think they had £6,000 on their credit card.
Yeah.
We looked at the difference between if they left the credit card there or paid it off. Now, the ridiculous thing was it was on interest free. So it made sense to leave the £6,000 and just pay it gradually off. But actually, the difference it made to them in practical terms, then paying off the £6,000 allowed them to borrow over £20,000 more on the mortgage. So although in theory it was better to leave it there, when we looked at it in practicality, they were like, well, I'll pay it off. I've got the money to pay it off. I just haven't, because it's interest free.
The client's not going to know that unless
No.
they're speaking to a property professional.
Yeah.
It's as simple as that, isn't it?
Yeah.
Now, down to the really important bit, special schemes for first-time buyers.
Yeah.
We found that after the Liz Truss scenario and rates were very high, lending was really difficult, and lenders kind of closed ranks and were like, yeah, we're really not that keen to lend, and changed criteria. In the last 6 months, we've seen lenders sort of really wide open the doors, and they are absolutely desperate to get first-time buyers to them. So they've opened up policy, opened up criteria, and launched some really good schemes that people may or may not be aware of. So if we talk about the first one, which may come as a surprise, where Skipton are offering 100% mortgage, just talk through the basics of that, because some of us will think 100% mortgages don't exist anymore. So talk me through that.
Yeah. So the kind of theory behind the Skipton track record mortgage is that particularly for renters, it's virtually impossible to get onto the property ladder. And the reason is because rents are so high that how on earth are they going to save a deposit? So the thinking behind the track record 100% mortgage is that they are looking to assess 12 months of rental income.
Rental payments,
over the last 18 months. So looking at those rental payments, and then potentially they will lend you up to 100% of your purchase price based on those rental payments. So if you can show that you've been affording rent at £1,200 a month for the last 12 months and you've paid it regularly, then that basically allows them to lend to you 100%, going, well, look, we know they can afford it because they've been paying it.
Which is groundbreaking. This sort of scheme has never been out before. It's new this year, or tail end of last year, and it's groundbreaking. As you said, for those renters who are paying hundreds and hundreds of pounds a month, how are you going to save for a deposit? So that's one option that's open to renters, basically, those who've got a track record. We've also got one with a £5,000 deposit, so not 5%, £5,000 with a cord.
Yeah. So again, they will go up to 99% loan to value.
Yeah.
So potentially, if you've got a £500,000 property with a £5,000 deposit, if you fit on affordability, they will lend you £495,000.
That's insane. Like, in a good way, if you can afford it, I mean. It's mad.
Exactly. So the idea behind it is that, again, the big kind of stumbling block for a lot of first-time buyers has been the deposit amount, and,
of course,
and being able to save that amount.
Yeah.
So, Accord have had a look at the market and gone, well, how can we help? What can we do within kind of what we're allowed to do within regulations to be able to open the market up a bit? And again, it's a great scheme that is aimed at first-time buyers to enable them to get onto the property ladder.
The next option really is just about affordability in relation to particular lenders that are standing out at the moment, where they're really bending over backwards to invite first-time buyers to them. We've got two of the biggest lenders currently in the market, Nationwide and Halifax, that offer helping hand and boost income.
Yeah.
What does that mean?
So basically, they've looked at the kind of market and gone, as well as deposit amount, the other thing that borrowers are struggling, particularly first-time buyers are struggling
and in the southeast,
is that their affordability is not where it should be to be able to borrow what they need. We can see that they're earning enough to pay the mortgage, but, historically, income has been capped at 4.5 times income. So what Nationwide have done, and Halifax to an extent, is they've looked at that income and said, okay, if you are earning over a certain threshold, and it does change, I think at the moment it's around about £32,000 sole, £50,000 joint. They're looking at that income amount and saying, okay, if you're earning over that, then we will even think of going up to 6 times your joint or single income.
Now, some people would have alarm bells, Yes. They'd be like, oh, they're over-lending, it's dangerous. However, these are all very calculated risks that lenders are doing, and they have formulas. They're not just willy-nilly throwing money out. They're saying, if you're on this income, we're going to assess your credit rating, we're going to assess your income, and our calculation shows that you will pay this. So it's backed by the FCA guidelines and the government trying to ignite the first-time buyer market. So it isn't irresponsible lending, because that is not what the FCA is about. However, it's all a calculated risk, and it's just giving those extra options to clients, isn't it?
Absolutely. And the way
this is only for first-time buyers. It's not for anyone else.
Buyers.
They can't get it.
And the rationale behind it is with the nationwide product, you can only fix for 5 years as a minimum, so that they know that you will be borrowing with them for a minimum of 5 years. And on that basis, what they're looking at is, for a lot of first-time buyers, they are likely to get promotions.
Yes.
They are likely to earn more over those first 5 years. And that's kind of how they're able to justify that additional lending.
The next scheme is specifically joint borrower sole proprietor, where you have a young person that can borrow a certain amount of money but can't quite get to where they need to be. They don't fit on any other schemes for whatever reason, but they have a relative that may be able to help them out financially, but that relative doesn't want to be caught up on the deed of a mortgage and affordability and all the rest of it. So in very simple terms, again, this scheme has been out for quite a few years, but is a lot of the time not known. What is joint borrower sole proprietor for a first-time buyer? What does it mean?
It sounds very complicated.
It does.
Historically, they were kind of known as kind of guarantor mortgages, a similar sort of thing. So the idea is the joint borrower might be daughter and parents or daughter and dad. And the sole proprietor just means that daughter is buying it on her own. So she will be the only owner of that property. Now, the reason that's important is because of stamp duty, because first-time buyers have a specific allowance that they are allowed for stamp duty. If dad was to go on the deeds of that property, it's no longer a first-time buyer purchase. So that's one of the reasons it's very important. But also the idea behind it is, although dad is on the mortgage, he's not on the property deeds. So daughter owns that property outright. And the idea is that dad's income could then be used to boost what the daughter can afford. Now, again, you might think, alarm bells, what happens, when dad retires? The idea of joint borrower sole proprietor mortgages, they're only ever really a short-term recommendation for getting someone onto the property ladder. It may be that someone's a trainee at work and they know in 2 years' time they're going to be fully qualified and their income is going to double. Those are the sorts of things that we take into account when we're looking at how can we help a client get their first property, and what ways can we do that are within affordability, but also allow them to get onto the property ladder.
And of course, what's really interesting, although we're not tax advisors, if a parent is on the deeds of a property, that can have impact for inheritance tax, whereas in this basis that is not the case, and therefore it's a win-win for a family, especially if there's more than one sibling.
Yeah, and weirdly I've seen it working even the other way round, where we've got kids helping out parents as well. So it's not just for first-time buyers, but it is something that is really helpful if you're just that little bit short of where you need to be to buy your dream home.
Yeah.
And, mum or dad are happy to say, well, look, we can boost your income.
Yeah. So that's really, really positive. So it's all good news for first-time buyers. Common pitfalls. I've just listed a few things here, not to overstretch. You kind of touched on that already. You might be able to, on paper, be able to borrow X, but if you can't afford to pay X back, we would be advising you on that, wouldn't we?
And I think most clients, when they come to see you, have a rough idea of what they can afford monthly. And even if they don't, once you start talking about, well, that much borrowing is going to cost you this much, they soon go, oh, no, I can't afford that. So when I'm sitting with a client, what I tend to say is, look, we'll look at what the maximum borrowing is that we can get you, but we also need to take account of the fact that you're going to have to pay council tax, you're going to have to pay gas and electricity, you're going to have to pay water, you're paying for your own groceries now. If you've been living with mum and dad, there's a lot of extra costs that you've got to take into account. So the last thing we want to do is stretch you to your limit on your mortgage and you can't even afford to buy a coffee.
No.
So it's that balance of being able to live life, but actually also be able to buy their first home. And sometimes, clients will say to me, well, I'm happy to go without holidays because this is the home I want. But as long as they're going into it with their eyes open, that this is what your monthly cost will be.
And it's having that conversation. Yeah. And the difference between going directly to a bank or coming to us is we can have those conversations. Banks and building societies don't.
No.
They're not allowed to. So the fundamental difference is we can give advice.
Yeah.
You go direct or you go online or you go do anything like that. You are not getting advice. You are not being steered through. You are choosing something and going down that route. We will take care of a client from a first-time buyer, and as we both have clients that have moved on, and some of our clients have been with us many years, and every time a mortgage need moves, we move with them. And that budget planner side of things is really important to us, and it is a regulation that we have to follow to make sure a client doesn't get into financial difficulty, which you can, like with our proposition for clients, is what we're there for.
Yeah, and I think I'd say to my first-time buyers, I feel that's where I bring my most value. Because you've never done this before. Why on earth would you know what any of this jargon means? You'll get a lot of stuff from solicitors. It's just nice to have someone on the end of the phone that you can pick up the phone and go, I've got this document in front of me. What does this mean?
Yeah.
And I think, it's a complicated process when you've done it before, let alone like the first time that you've done it.
Absolutely. And again, it's one of our sort of selling points to our clients is that we will be on the end of the phone, whether it's a solicitor related, property related, survey related, etc. We're the experts, and we can talk them through that. Hidden costs we need to look out for. Are there any?
Yes, I think a lot depends on the property that you're buying, but the one thing that I always flag up with my clients is if you're buying a flat, what is really important to look at is your ground rent and your service charge. Those are both costs that a lender will take into account. I had a client recently who was buying a property, I think for about £250,000, but the ground rent, the service charge was £4,000 a year. And so when we looked at that and I said, do you realise how much this is going to cost you monthly for this flat? He said, oh, no, I hadn't. And actually, he walked away from that particular purchase because when you added that to a mortgage as well, the cost of buying what was a relatively reasonable flat suddenly became very expensive.
And I'll bring our role in the process very clearly that we act for the client. We do not act for the lender. We do not act for an estate agent. We act for the client. So we are always putting their best interests at heart. Also, due to confidentiality, we don't share your details with anyone, estate agents, solicitors, of course, standard, because otherwise we wouldn't have any clients. So the client, the first-time buyer or the home mover is our priority, come what may.
And I don't know about you, Jo, but sometimes I even find that our job is to challenge our clients.
That's right.
And to say, well, have you thought about this? Have you thought about that? Because it is their first purchase. It's the most money they're ever likely to spend. And the ridiculous thing is they'll probably view that property twice.
Yeah.
So sometimes I think our role can just be to say, well, have you thought about you're at the top of a high rise and there's no lift? That can be an issue for some lenders. Little things like that you possibly wouldn't even think about.
No.
That we can, because we've been around for a while,
Speak for yourself. No, that's great. And we don't want to blow our own trumpet, but we are amazing. We are great with our clients. Our clients love us, and the longevity of how long we've been around.
I think it makes people feel like with their mums.
Yeah. No shade there. Okay, I think that's it. Just to recap, benefits of coming to a broker are
affordability. So finding out very early on, well, what can I afford?
Yeah.
And then also we can point them in the right direction for things they can do to kind of work towards their first purchase, whether that's next week or in a year's time.
You know what else we haven't talked about is plan A and plan B and plan C. So sometimes we'll have a client, we'll apply to buy a property, we apply to lender, we come across a stumbling block. We had one last week where a client was buying a property that had a flying freehold they weren't aware of. We applied to lender declined it. We're then able to go, right, what's our plan B? We go to the next lender and go, are you okay with the flying freehold on this property? Yes, we are. and we're able to get the client over the line. So again, coming through at someone like us, we have a plan A, B and C. We don't necessarily ideally want to do plan B and C, but it's there should it be needed, which is our sort of skill.
And I think the thing for me, for any first-time buyers out there, is it's sort of 3 steps to think about. Number 1 is see a broker. And we would always recommend a whole of market broker. There are brokers out there who are only tied to certain lenders. So investigate that, read reviews, go onto Google, go onto FIFO, look at their reviews. And see a broker first and foremost. And then look at your credit file, see what you can do. And then, unfortunately, the bottom line is save, save, save.
Yeah, absolutely.
The larger deposit you've got, the better the interest rate and the more options you have as a buyer. So although there are all these amazing schemes out there for first-time buyers, the bottom line is the more you've saved, the better your options are.
Thank you so much, Katie, again for joining us today, helping out first-time buyers, and hopefully we can do another session. I don't think we've even covered everything today, have we?
No, I would say just get in touch with us if you want to know anything more about lifetime ISAs, shared ownership. There's lots of other schemes that we just haven't had time to talk about. And obviously all of those areas we can cover off with you as well.
My name's Jo Williams. Thank you for joining us and Home Estate Agents. And we'll see you at our next podcast.